Hello and welcome to Beyond the Charts. This is a show where we dive into fascinating charts from the world of finance and the economy, and we break down what is really going on. If you want to view all the charts and sources that I discussed in these videos, please check out our newsletter. You can find all the links in the description below. Now, in the last episode, we looked at a range of high-frequency indicators in order to get a sense of how the Indian economy is doing. The TLDR over here is that the Indian economy has been losing some steam as of late. You'll find a link to that episode in the description below in case you're interested in catching up. But in this episode, let's shift our attention to the global economy first and pay attention on the United States to begin with. The reason is of course because it's the world's largest economy, and as they say, if the US sneezes, the rest of the world catches a cold. Also, for your information, in the upcoming videos, we'll be looking at Europe, China and other major economies as well. But before we even get on to zooming into the US, let's start with the big picture of the global economy first. See, the International Monetary Fund or the IMF released their latest World Economic Outlook in the month of October. In this report, it said that the global economy is settling into a period of stable but underwhelming growth. They projected the global GDP to grow at 3.2% in the year 2024. The number was largely unchanged from its previous reports in April 2024 and in October 2023. In fact, the IMF projects that even in 2029, the growth will be in the same range of about 3%. What's interesting in this trend is the growth rate of the global economy. Before the 2008 global financial crisis, the global economy grew at an average rate of about 4.4%. Between 2011 and 2019, the global economy grew at about 3%, but now it has slowed down to an average of about 2.7%. You might ask, why is this so? See, the world economy is slowing down for three major reasons. First, companies are not working as efficiently as they used to. The right people and money are not going into businesses that could use them the best. Second, many countries have aging populations now, which means fewer working age people are available. By the year 2030, the growth in available workers worldwide will be just 1/3 of what it was 10 years ago. The third reason is that since the 2008 financial crisis, businesses have been very cautious about spending money on growth because they are fairly unsure about the future and they often sometimes struggle to get funding as well. So unless we see some really big changes in government policies or we get help from new tech like AI, the world's economy might continue to grow at less than 3% by 2030. That is also, by the way, 3.8% down before COVID-19 hit. Now, it's been about a month since the IMF published its outlook. More recently, India's central bank pointed out that global growth has slowed down even because of rising tensions between different countries. But on the bright side, the IMF says that the initial strong momentum towards disinflation, which is where inflation rates decrease, has slowed down significantly. While goods inflation has begun to stabilize or decline, services inflation remains elevated due to continuing high wage growth. Now, given the uneven distribution of inflationary pressures, different countries are handling their monetary policies in very different ways currently. Most developed countries except Japan had lowered their interest rates, but it is not so simple for growing economies like India and some others. Some of the countries can lower their rates while others cannot because prices are rising so fast. India, for example, has not cut its interest rates at all. So simply put, richer countries are mostly able to relax their monetary policies as prices are starting to stabilize, while growing economies still need some strict policies in order to control rising prices. Another data point that gives you a sense of the global economy here is the world's merchandise trade volumes, or the volume of goods that are traded across the global economy. Now, the United Nations' latest report shows that countries are trading fewer goods with each other right now. This drop in global trade is mainly because European countries are struggling, especially Germany, Italy, and the United Kingdom. In fact, Europe's economy as a whole is not doing well at all currently. On the other hand, services trade between countries is also starting to slow down. Now let's move on and look at the world's biggest economies. The US over here continues to lead the pack. For the third straight year, it is growing faster than other developed nations. According to the IMF predictions, the American economy should expand by 2.8% this year, followed by 2.2% growth in 2025. And this is pretty crazy considering the fact that just in mid-2023, most experts were fairly convinced that US was heading for a recession. But the economy proved to be much more resilient than anyone expected. Currently speaking, the US economy is doing phenomenally well. The latest growth estimates from the Atlanta Fed, which is one of the 12 Federal Reserve regional banks, show that the economy is still charging ahead very strongly. Consumption is about 70% of the US GDP. In fact, the US is the largest consumer in the world and a huge source of demand for a lot of economies as well. The economic performance of many economies like Mexico, China, Canada, and the others is directly tied to how the US economy does. So, if the US consumer is not doing well, then the rest of the world will certainly be in trouble. But right now, the US consumers are doing phenomenally well. Personal savings have moderated from COVID 19 peaks but have still remained steady. This means consumers are still not overly stretched, so to speak. Now, this shows up in consumer confidence surveys as well. Consumer confidence hit a low just as US inflation hit a peak in mid 2022, and since then, as inflation has come down, consumer confidence has also recovered. Personal spending has also stayed pretty strong, even in the face of high inflation and rising borrowing costs. Now, here's another data from the Bank of America which measures credit card and debit card spending growth amongst its consumers. This has also been remarkably strong. The labor market also remains very strong despite all the headlines we've been reading about. When more people are working and are able to find jobs, it is usually a good sign to the economy, and right now, that is exactly what we are seeing. The strong job market is suggestive that the US economy is doing better than most people expected. The US is also doing well on the inflation front. This has prompted the US Federal Reserve or the US Fed to cut interest rates from 5.5% to 5%. While inflation is still running a little bit above the Fed's ideal target of 2%, it has dropped enough that they are now comfortable in lowering interest rates. They basically think that keeping interest rates high at this point would do more harm than it would do good. But Fed Chairman Jerome Powell is playing it safe here. He recently said, and I quote, "The economy is not sending any signals that we need to be in a hurry to lower rates. The strength we are currently seeing in the economy gives us the ability to approach our decisions carefully." Now, you might wonder why the Fed is cutting rates when inflation is still above their target. See, the answer is pretty straightforward. They are planning ahead. Changes in interest rates don't quite affect the economy overnight as you could imagine. Think of it like steering a large ship. You have to turn the wheel well before you want to change the direction. So when the Fed changes rates, there is often a delay before we actually feel the effects. Banks also need some time to adjust their own rates for loans and savings accounts, and it usually takes even longer for these changes to ripple through businesses and to consumers in turn. So therefore, the Fed has to think several moves ahead rather than just reacting to today's conditions. In the US, inflation in areas like gasoline, car prices, both new and used, are not quite climbing as fast as they were, and food costs have also cooled off. But not everything is moving in the same direction right now. Some everyday expenses are still pinching Americans' wallets. Transportation costs remain fairly high, housing costs are continuing to rise, and electricity bills are still growing faster than people would like it to. So while the overall inflation picture has definitely improved from its peak, it is a bit of a mixed bag when you look closer. Shelter inflation is a major component of the US Consumer Price Index. It includes rent payments, hotel stays, and similar housing costs. The inflation in this sector has remained quite high. It is currently at 4.9%. Now, this is a big deal because housing usually takes the biggest bite out of people's monthly pockets. When your rent keeps going up faster than your paycheck, it leaves very little money for everything else. So even if other prices like gas or groceries are starting to level off, so to speak, high housing costs can still make it feel like your money is not going as far as it used to. To add some context here, the US housing market has seen some major changes since 2020. When COVID hit and the Fed cut interest rates nearly to zero, mortgages became much cheaper. This combined with the ease of remote work led to increased demand for homes. Meanwhile, housing supply was also limited. Construction slowed down during the pandemic and building materials got more and more expensive, and investors were actively buying properties. So all of these factors pushed housing prices up pretty significantly. And while prices are not quite rising as quickly right now, they remain much higher than pre-pandemic levels. So this has created a serious affordability problems. Many Americans are finding it increasingly difficult to buy homes right now. But overall, the US economy is still doing pretty well. And as long as the US economy does well, the global economy will continue to be steady. Let's then move on to the second section and talk about tariffs. See, in the post-COVID period, geopolitics has been the dominant risk for financial markets, from the Russia-Ukraine war to the conflicts in the Middle East to even rising tensions between China and the US. Now, there have been various buzzwords that are thrown around like deglobalization, de-dollarizations, snowballization, fragmentation, and whatnot. Now, all of these things have become even more important as Donald Trump is preparing to take office as the president of the US. The biggest worry on everybody's mind is whether or not he will impose tariffs, not just on Chinese imports, but also on the rest of the world. So with that, let's take a look at how global trade has done over the last few years and what impacts the tariffs would have on global economies. See, since 2012, world trade as a percentage of GDP has not really declined, but it has plateaued. The IMF and the World Trade Organization both have pointed out that there are signs of fragmentation that are emerging now. The first thing that is happening is that countries are trading more with other countries that are more friendly than other countries. The other indicator that is pointing towards things getting worse is the number of trade restrictions that are imposed by countries. Since Russia invaded Ukraine, we've seen a sharp rise in trade restrictions worldwide. Countries are putting up more barriers to control what goods can move across their borders now. So it is in this context that Trump will take office as the president of the United States. So therefore, the biggest question becomes, what will be the impact of Trump's tariffs on the world? Who will be the winners and losers? See, Trump's administration is talking about increasing tariffs on Chinese imports, potentially up to 60% on some goods, and may also add a blanket 10% tariffs on everything imported from other countries. These measures aim to pressure foreign suppliers but may not significantly destabilize the US economy due to prior adjustments in trade patterns. Now, since the first round of tariffs back in 2018-2019, the US has learned to rely less on China. Many businesses have now started to buy from other countries like Mexico and Canada instead of China. In fact, China's share of US imports dropped from 21% in 2016 to less than 15% in 2024. This reduction has helped businesses diversify their supply chains and spread risks, but it does not entirely eliminate their dependence on China for key sectors like electronics and pharmaceuticals. But if tariffs are applied to all imported goods, regardless of where they come from, the economic impacts will be much broader. A 10% across the board tariff would weigh heavily on US GDP and would lead to a 0.36% decline by 2026 as per the PIIE working paper. Other economies like Canada and Mexico would face even greater challenges here. Mexico in particular is heavily reliant on trade with the US, with exports accounting for a significant portion of its GDP. As a result, the same 10% tariff is expected to cause Mexico's GDP to decline by 28 billion US dollars in a non-retaliation scenario, and as much as 53 billion if retaliatory tariffs are introduced. While Canada would also feel the pinch, the impact is far smaller as compared to Mexico. This is because Canada's economy is slightly more diversified and less reliant on exports to the US in industries that are heavily affected by tariffs like manufacturing. But still, sectors like automotive and agriculture would see some disruption here. The European Union would experience moderate effects, with countries like Germany taking a hit which relies heavily on exporting machinery and vehicles, much of which ends up in the US. A 10% tariff could make these products a lot more expensive, could reduce demand, and could also slow down growth. Also, despite its reduced trade reliance on the US, China would still face significant consequences. Sectors like electronics and machinery, which are major export industries, would be hit the hardest here. A slowdown in Chinese exports would also ripple across global supply chains, affecting countries that depend on Chinese intermediate goods. As tariffs increase, businesses across sectors would face higher input costs, while consumers might pay a little more for everyday items like electronics, groceries, clothing, etc. Tariff-driven price hikes were evident during the 2018-2019 trade war, when prices of core goods in tariff-affected categories rose pretty sharply. A similar inflationary pressure could resurface this time around. Higher tariffs are expected to raise US core inflation by 1.2% under a 10% universal tariff, according to Peterson Institute data. This would strain household budgets and undo recent progress on inflation control. There's another worry as well. Other countries over here might respond with their own tariffs and could create a ripple effect across the economy. Retaliatory tariffs by trading partners could magnify the economic damages. Sectors like agriculture, durable manufacturing, and mining, which rely heavily on exports, would be the most affected here. These are the very sectors that tariffs are meant to protect for that matter. This impact would also hit regions like Europe, which depend heavily on trade. The Eurozone could see a GDP contraction of nearly 0.9% as compared to 0.3% hit to the US as per the Goldman Sachs report. Despite reduced trade ties, the US remains one of China's biggest customers. New tariffs could still hit Chinese industries hard, especially electronics, machinery, and textiles. A 60% tariff on Chinese imports would reduce China's GDP by 0.9% by 2026 as per the PIIE report. While Beijing might introduce stimulus measures to counteract the slowdown, global supply chain disruptions could take many years to stabilize from here. While targeted tariffs on Chinese goods have had a reduced economic impact, the broader implications of across-the-board tariffs could be far-reaching. Inflationary pressures, retaliatory measures, and the resulting global ripple effects would make the next round of tariffs a little more damaging than they did before. The US economy might have adjusted to fewer Chinese imports, but a universal tariff policy risks reversing some of these gains and increasing costs for both businesses and households. With that, let's move on to the next section and take a look at the rise of sectoral and thematic funds in India. See, whenever something starts doing well, everyone wants a piece of the action for sure. Nobody wants to quite miss out on a trend which is making money. And that is what we are currently seeing with sectoral and thematic funds this year. See, these funds which focus on specific sectors or themes have attracted 42% of all money flowing into equity mutual funds, which amounts to 1.32 lakh crores by October. To put that into perspective for you, this is more than the total inflows that we saw during both 2022 and 2023 combined. Now, if you're not quite familiar with how sectoral or thematic funds work, think of them as a basket of stocks that are tied to a single idea. Unlike regular mutual funds which spread your money across various sectors, these funds zero in on a particular sector or a theme like electric vehicles, for example. Sectoral funds focus on a single industry like banking or pharma, while thematic funds invest across sectors but are unified by a central trend like EV funds investing in automotive, battery manufacturers, and related industry. Now, given how popular these funds have become over time, we decided to take a look and see how different sectors have actually performed over time. Let me quickly start with the major sector indices. If you go by the data up to the end of October 2024, most major sector indices have had a fantastic year, with 8 out of 13 doing better than the Nifty 50 index in the past 12 months. But here's the thing here, when you look at the long-term performance, say over 5 to 10 years, most sectors end up giving returns that are pretty similar to the Nifty anyway. Let's then come to the thematic indices which have become quite popular this year. And I'll also figure why this is the case. Over the last 6 and 12-month period, most if not all of these themes have given spectacular returns. But if you extend the time horizon, the returns are not that impressive and they are just keeping pace with the broader market. Why does this happen, you might wonder? See, it is because sectors and themes tend to perform in cycles. They'll have their moment when they outshine everything else. But once that cycle ends, they usually go long stretches of underperformance, and these downturns can be fairly brutal. Some sectors and themes have seen their value drop by over 75% during bad phases. Timing the market to ride the cycles perfectly is almost impossible, as you and I know. That's because most of us aren't going to buy at the bottom and sell at the peak. We are not just wired that way for obvious reasons. More often than not, people end up buying high when the hype is strong and selling low when things start to turn. Also, a big part of why people are actually attracted to these funds is actually psychology. When something is doing well, it is hard not to feel like you are missing out. This fear of missing out or FOMO makes us chase trends without thinking about the risks in the first place. There's also something called the recency bias, where we assume that just because a fund has been doing well recently, it is going to keep performing in the same way. But if you dig into the history, you'll see that it has rarely been the case. Let's take some real life examples. Back in 2007, the realty sector was on fire. Everyone wanted a part of it, and then the global financial crisis hit. Realty stocks crashed and lost 90% of their value from their peak. Even now, 17 years later, the sector has not really recovered from these levels. The PSU bank sector is one more here. It has performed very well in the last 3 to 4 years, but historically speaking, the performance has always been highly cyclical, with sharp declines during tough economic times. And the reason for this cyclicity is how closely these funds are tied to larger economic and policy trends. For example, government programs like Make in India or the push for electric vehicles have driven interest in manufacturing and EV themes. Now, these ideas are exciting, but they are also dependent on factors like government subsidies, infrastructure, and global demand. If those things slow down, so do the returns. Now, does this mean you should avoid these funds altogether? Not necessarily. If you truly believe in a theme and have the patience to ride the ups and downs, they can be a good addition to your portfolio. But they should not be the sole focus of your investments. And you also need to be ready for some serious volatility here. So if you are someone who gets nervous when the market drops, these funds might not be for you. Trends come and go, and while it's tempting to jump on a bandwagon, long-term investment is a marathon, not a sprint. That's all that I had for this episode today. I hope you enjoyed this show and found some value in it. Please share your thoughts in the comments down below, and we would love to interact with you. This is your host Anurag Bansal signing off. I'll see you in the next one.